Hey guys, welcome back to the Bitcoin Fortress podcast, episode 229. It's Sunday, August 16th, 2026, and we are recording at block height 962764, Moscow time 1583. And if you need to move some Bitcoin today, the mempool continues to be extraordinarily quiet with fees sitting at basically 1 sats per VByte. So Bitcoin keeps producing blocks, transactions remain incredibly cheap, and meanwhile, the price continues to grind through what has become a pretty frustrating bear market. But I actually think this was a very interesting week because there's a growing disconnect between the price of Bitcoin and the infrastructure being built around Bitcoin. Bitcoin spent most of the week trading roughly in the low to mid 60s. We have now been stuck in this general range for quite a while. Volatility has collapsed, speculation has dried up, the tourists have largely left, and Bitcoin is down dramatically from the highs. Yet, if you ignore the chart for a moment, something very different is happening underneath the surface. Banks are increasing their Bitcoin exposure. Bitcoin-backed credit is beginning to become an institutional asset class. Goldman Sachs is buying an asset manager that operates Bitcoin income ETFs. Bitcoin miners are finding entirely new business models through AI infrastructure. Tether has finally completed a Big Four audit. Federal banking regulators continue bringing digital asset companies inside the regulated financial system, and some of the largest Bitcoin holders in the world appear to be accumulating again. That's not what a dying asset looks like. It actually looks much more like what we have discussed many times on this show. The price is cyclical, adoption is structural. We have a lot to cover today. I've filtered out most of the nonsense and tried to focus on the developments that I think will still matter 6 months or a year from now. And so with that, let's get into it, starting with Bitcoin market structure. So let's start with price, but only briefly. CoinDesk described Bitcoin this week as essentially trapped between roughly $62,000 and $66,000, with ETF demand on one side being offset by selling from miners and corporate holders on the other. Trading volume and implied volatility have fallen dramatically. That is pretty good description of what we are seeing, and I think this matters because this is what a mature bear market often feels like. Not panic, not euphoria, just boredom. Nobody wants to talk about Bitcoin. Nobody wants to trade it. Volatility disappears. The same price levels get revisited over and over again. Bitcoin's 30-day implied volatility fell back toward a 2026 low around 36% this week. That is fascinating because Bitcoin is becoming boring at precisely the moment when the surrounding institutional infrastructure is becoming more interesting. There's another possibility here too. This may be a market transitioning from price pain to time pain. That phrase came up repeatedly in the Bitcoin podcast universe this week, and I think it is exactly right. Maybe 58,000 or 60,000 was the capitulation event. Maybe we don't need another giant flush. Maybe Bitcoin just goes sideways long enough to exhaust everyone. That could be psychologically harder than a crash because there's no dramatic event to react to. You simply wait. And Bitcoin is very good at making people wait and making people humble. The ETF picture provided another useful signal. After a strong start to August, U.S. spot Bitcoin ETFs registered about $192 million of back-to-back outflows, the first two consecutive negative days since late July. Remember that the week before, the ETFs had attracted roughly $850 million of Bitcoin inflows. So demand hasn't disappeared, it is simply inconsistent. And that distinction matters. The ETFs have become one of the permanent marginal buyers of Bitcoin, but they are not an infinite bid. When investor sentiment weakens, ETF flows weaken, and that's healthy. I'd rather Bitcoin eventually build a durable base around thousands of different buyers than depend upon one giant source of demand continually driving price upward. ETFs also change the character of Bitcoin cycles because large pools of institutional capital now have an extremely easy entry point. When sentiment turns again, money can move into Bitcoin much faster than it could during earlier cycles. Here's the interesting counterpoint. CoinDesk reported that the number of wallets holding at least 10,000 Bitcoin has climbed to a 6-month high, while addresses holding between 10 and 10,000 Bitcoin collectively added roughly $1.5 billion worth of Bitcoin beginning in late July. Obviously, wallet analysis is imperfect. One address does not necessarily equal one investor. But directionally, I pay attention to this. One of the great recurring patterns in Bitcoin is that coins migrate towards stronger hands during periods of weakness. Retail tends to become discouraged precisely when the larger investors become interested. That is not unique to Bitcoin. It happens in virtually every asset market. Difference is that Bitcoin lets us observe some of this behavior directly on chain. And when I combine whale accumulation with low volatility, exhausted retail sentiment, and a roughly 50% drawdown from the cycle high, I find the setup much more interesting than the price chart alone suggests. Now for the other side of the equation. Public Bitcoin miners have reportedly generated roughly $1.78 billion of selling pressure, an underappreciated source of supply hitting the market during this bear cycle. This is important. Bitcoin miners live in dollars. They may earn Bitcoin, but they pay for electricity, equipment, employees, leases, and debt service largely in fiat. When hash price falls and margins compress, miners often sell more Bitcoin. That creates a natural source of supply during bear markets. But this brings us to one of the most interesting structural developments of the week as we move into mining, energy, and AI. Bitcoin Magazine published an excellent piece arguing that the popular narrative about Bitcoin miners abandoning Bitcoin for AI gets the story backward. AI hyperscalers need extremely reliable grid-connected power, low-latency fiber, and enormous amounts of electricity. Bitcoin miners need cheap energy and flexibility. Those are different workloads. Bitcoin mining can shut down within seconds when the grid needs power. AI training generally cannot. And Bitcoin miners spent years acquiring something the AI companies desperately need today: energized land with existing grid interconnections. New large power connections can take years to obtain, so suddenly the miners own extremely valuable infrastructure. Rather than Bitcoin miners simply abandoning mining for AI, many of them may become sophisticated energy companies allocating megawatts to whichever workload produces the best return. I think this is one of the most important mining developments we've discussed this year. Imagine a hybrid company. AI workloads provide predictable dollar cash flow. Bitcoin mining monetizes stranded or interruptible energy. The AI revenue pays corporate overhead. That means fewer Bitcoin sales during bear markets. And Bitcoin mining provides demand response flexibility that AI workloads cannot. That is a very interesting business model. The market spent years valuing miners based mainly on hash rate. Perhaps the better framework ultimately becomes energy infrastructure plus optional compute. Bitcoin was simply the technology that incentivized these companies to secure the power infrastructure first. There's another angle here. AI continues attracting extraordinary amounts of global capital. CoreWeave reported a backlog exceeding $100 billion while continuing a massive expansion in power capacity. This matters to Bitcoin because capital is finite. One plausible explanation for Bitcoin's strange underperformance in an otherwise strong liquidity environment is that AI has become the dominant speculative destination for global capital. That doesn't necessarily make Bitcoin's monetary thesis weaker. It may simply mean Bitcoin is currently competing with the biggest technology capital cycle since the internet. And here's the irony. If that AI boom ultimately requires extraordinary borrowing, electricity infrastructure, government incentives, and monetary accommodation to sustain itself, the financing of AI could eventually reinforce the Bitcoin thesis. Debt-financed technological abundance does not eliminate monetary scarcity. It may increase the value of it. Moving along to corporate Bitcoin and treasury companies. This was another notable development. Strategy disclosed that it sold another 1,690 Bitcoin worth roughly $109 million, marking its fourth consecutive week of Bitcoin sales. Over those 4 weeks, it sold roughly 6,900 Bitcoin. That would have sounded almost unthinkable a year ago, but I think we need to understand strategy differently now. This is no longer simply Michael Saylor buying Bitcoin forever. It is becoming a very large and increasingly complex financial institution built around Bitcoin. Strategy has common equity, convertible debt, preferred securities, dividend obligations, and a growing dollar liquidity reserve. Bitcoin may remain the core asset, but the company has liabilities that exist in dollars. That changes the equation, and this bear market is testing the structure. I don't view that as inherently bearish for Bitcoin. I view it as a real-world stress test of the Bitcoin treasury company model. A good model needs to survive bad markets. That stress test became more interesting this week. MSCI is consulting on rules that could classify companies like Strategy and Metaplanet as essentially non-operating companies, potentially excluding them from certain equity indexes. Strategy pushed back, arguing that index providers should measure markets rather than dictate which assets corporations are permitted to hold. This sounds technical, but it matters. Index inclusion creates passive demand. If Strategy gets removed from major indexes because too much of its balance sheet consists of Bitcoin, index funds may be forced to sell shares. So we are beginning to see something fascinating. Bitcoin treasury companies sit awkwardly between traditional categories. Are they operating companies, investment companies, leveraged Bitcoin funds, something entirely new? The market just hasn't decided yet, and neither have regulators or index providers. I suspect we will eventually need a new category for these businesses. Meanwhile, Metaplanet in Japan continues experimenting with another piece of the capital stack. The company completed the first issuance under a new continuous bond program it calls BitBonds, issuing about 200 million yen in unsecured senior debt with roughly 3-year maturities and interest rates around 4 to 4.3%. This is where the Bitcoin treasury model becomes really interesting. Common equity was phase 1, convertible bonds were phase 2, preferred securities and structured credit are phase 3. Eventually, Bitcoin treasury companies may issue conventional investment grade debt. If that happens, Bitcoin is effectively being integrated into the global credit system through corporate balance sheets. That is a much bigger story than whether Bitcoin trades at 63,000 or 73,000 next month. Moving right along to Bitcoin credit. CoinDesk had another excellent piece this week describing Bitcoin-backed lending as entering an institutional phase. Public companies are increasingly borrowing against Bitcoin holdings instead of selling them to fund acquisitions or capital expenditures. This theme also showed up prominently in the podcast universe, which we'll talk about a little later. This is an inevitable development if Bitcoin becomes a major global store of value. People do not want to sell productive collateral. Real estate owners borrow against property. Businesses borrow against assets. Wealthy families borrow against securities. Eventually, Bitcoin will become collateral too, but we should not romanticize this. Bitcoin-backed lending creates liquidation risk. It introduces counterparty risk. It introduces rehypothecation risk. And we've already seen what happens when supposedly sophisticated crypto lenders become reckless. The promise is enormous. The danger is enormous too. The correct lesson isn't never borrow against Bitcoin. The lesson is understand exactly what you're doing. Next up, Wall Street keeps moving in. UBS disclosed that it now owns roughly 2.5 million shares of BlackRock's IBIT, worth more than $83 million. This isn't an earth shattering number for UBS, but that is actually the point. Bitcoin exposure is becoming ordinary. A major Swiss bank owning $83 million of a Bitcoin ETF barely qualifies as shocking anymore. 3 years ago, that headline would have been extraordinary. Today, we read it and we move on. The normalization is adoption. Goldman Sachs announced an agreement to acquire Neos Investments for approximately $2.25 billion, bringing a firm that operates Bitcoin-related income ETFs inside Goldman. Again, think about the direction of travel. Wall Street spent years arguing about whether Bitcoin should exist. Then it built ETFs. Then banks began distributing Bitcoin exposure. Now major financial institutions are buying companies whose product suites include Bitcoin strategies. The question isn't whether traditional finance adopts Bitcoin anymore. It already has. The interesting question is what Bitcoin does to traditional finance once it gets inside. Next up, regulation and the Clarity Act. So let's head to Washington. The Senate left for its 5-week August recess without advancing the Clarity Act. Senate Majority Leader John Thune had set up a procedural vote for September 15th, but the legislative calendar is getting extremely tight heading toward the midterm elections. Reuters reports that significant disagreements remain around ethics rules, stablecoin rewards, banking competition, and anti-money laundering provisions. Prediction market odds of passage this year have fallen dramatically. I've been following Clarity closely because I think this legislation has implications far beyond token classification. One of the recurring concerns in financial regulation is that legislation advertised as creating clarity can actually become infrastructure for broader surveillance and control. That does not mean clarity is inherently bad. There are useful provisions. Developers need protection. Self-custody needs protection. Markets need basic regulatory boundaries, but Bitcoiners should always ask a second question. What powers are being created in exchange for that clarity? Because the history of financial legislation tells us that emergency powers and compliance infrastructure rarely shrink once established. So we'll keep watching this one closely in September. The SEC planned to vote this week on a new framework being called Regulation Crypto, potentially providing exemptions and safe harbors for certain digital asset offerings. Then the SEC abruptly canceled the meeting because of what it described as an unforeseen scheduling issue. That sequence is revealing. Congress may be stuck, but regulators are not necessarily waiting. If clarity dies, the SEC and other agencies may attempt to construct large portions of the regulatory framework administratively. That can provide short-term clarity, but legislation tends to be more durable than agency interpretation. Future administration can change regulators and reverse policy. So while industry participants may welcome regulatory relief, congressional action still matters. The Office of the Comptroller of the Currency conditionally approved a national trust bank charter connected to World Liberty Financial. The charter would allow the entity to custody assets, manage reserves, and directly issue its USD1 stablecoin under federal supervision, although it would not operate like a conventional deposit-taking bank. Ignore the political personalities for a moment. The structure development is much larger. Digital asset firms are moving inside the federally chartered banking system. Circle, Ripple, Bridge, now World Liberty. The boundary between crypto and banking is disappearing. Stablecoins in particular are turning into a new type of narrow bank. They take in dollars, they buy treasury securities, they issue digital dollar liabilities, and increasingly they operate under bank-like regulatory frameworks. This is why stablecoins are enormously important to the US Treasury market and dollar hegemony. They're not replacing the dollar, they're exporting it. Next up, stablecoins and global money. Here's a significant milestone. Tether announced that KPMG US completed a full independent audit of its 2025 financial statements. The first time Tether has completed the Big Four audit is promised for years. The full audit itself has not yet been publicly released, so I would not declare the transparency debate finished, but this is meaningful progress. Tether has become one of the largest buyers of US Treasury securities in the world. USDT is effectively a global offshore dollar network. At that scale, trust us is no longer enough. If stablecoins are going to become systemically important monetary infrastructure, audit quality matters. And there's a delicious irony here. A company built partly because people wanted alternatives to traditional banking is becoming one of the world's largest holders of government debt. Bitcoin and stablecoins may both use blockchain infrastructure, but philosophically, they are very different things. Bitcoin challenges monetary discretion, stablecoins extend it. Russia's central bank is proposing rules that would initially permit ordinary retail investors to trade only Bitcoin, Ether, and USDT on regulated exchanges, while limiting non-qualified investors to roughly 300,000 rubles in annual purchases through each intermediary. Whatever you think about the restrictions, there is an interesting signal inside them. When regulators are forced to distinguish between thousands of digital assets, Bitcoin repeatedly ends up in the small group that survives. Why? Because Bitcoin has liquidity, network security, global recognition, and no issuer. The larger crypto universe may remain enormously speculative, but Bitcoin, well, it keeps becoming infrastructure. Next, let's talk about security and self-custody. So, after everything we discussed last week surrounding the cold card vulnerability, another security story arrived. Treasury disclosed a data breach involving information belonging to 13,689 customers, including names and email addresses connected to hardware wallet purchases. Importantly, this is not the same type of vulnerability as compromised private key generation, but it can still be dangerous. Knowing that someone owns a hardware wallet is valuable information. It creates a phishing risk, social engineering risk, potential physical security risk. This is why Bitcoin security is much broader than protecting seed words. You have key security, device security, privacy security, physical security, and you have operational security. Bitcoin lets you eliminate many financial intermediaries, but that means you inherit responsibilities those intermediaries previously handled. That's the trade. Sovereignty is wonderful. Sovereignty also requires competence. Next up, let's take a little trip through macro. July CPI came in around 3.4% year over year, down slightly from 3.5%, while core CPI eased as well. Markets consequently reduced the probability of another Federal Reserve hike at the September meeting. But I would not declare victory over inflation. The Fed's preferred PCE inflation measures remain well above the 2% target, with estimates still above 3%. Long-term Treasury yields remain elevated. Energy markets remain vulnerable to geopolitical disruption. Government borrowing remains enormous, and the Fed is trapped. Raise rates too aggressively and you destabilize highly leveraged markets. Ease too aggressively and inflation can reaccelerate. This is the same monetary box we've discussed for years. Bitcoin doesn't need the Federal Reserve to fail spectacularly. It simply needs fiat currencies to keep doing what fiat currencies historically do: expand. So, stepping back from all these stories, what actually happened? Bitcoin traded around 63,000 and everyone complained. Meanwhile, major banks increased Bitcoin exposure. Goldman bought deeper into Bitcoin financial products. Bitcoin-backed lending moved toward securitization. Treasury companies developed new credit structures. Miners found new ways to monetize energy infrastructure. Tether got a Big Four audit. Federal regulators moved stablecoin companies into the banking system. Large Bitcoin wallets accumulated, and Bitcoin quietly kept producing blocks for essentially 1 sat per V byte. That's the story. The price is having a bear market, but Bitcoin is not. Now let's jump into the Bitcoin podcast universe for the week. There were several recurring themes across the podcasts, and interestingly, they do line up with the news. So on what Bitcoin did, the data says Bitcoin's bottom is already in. Mitchell Askew and John Haar joined Danny Knowles for a discussion about whether Bitcoin's bottom is already behind us. Askew put his confidence at roughly 95% that the bottom is in, although he believes Bitcoin could remain range-bound for months. Their most interesting argument was that Bitcoin has already experienced the price pain, but investors may still need to experience the time pain. They discussed miner selling, OG holder distribution, strategy, Metaplanet, the AI capital cycle, and the possibility that the traditional 4-year Bitcoin cycle is becoming less violent as the asset matures. I found that framing persuasive. The most psychologically effective bear markets don't necessarily end with fireworks. Sometimes they just become boring enough that everyone stops paying attention, and that feels very close to where we are now. Also on what Bitcoin did, the $1 trillion Bitcoin loan market is coming. Mauricio Di Bartolomeo joined what Bitcoin did for what I thought was one of the more important discussions of the week. He believes Bitcoin-backed lending could eventually become a $1 trillion market. The episode discussed Ledden's roughly $188 million Bitcoin-backed securitization, institutional credit markets, partial liquidation structures, and the dangers of so-called no-liquidation loans. This connects directly to our earlier story. Bitcoin collateral is beginning to enter traditional credit markets. That is enormously bullish structurally, but we should retain some scar tissue from Celsius, BlockFi, and the previous cycle. Yield always comes from somewhere. Leverage always has a liquidation price. Counterparties always matter. The technology improves. Human nature generally doesn't. Next up from TFTC, Energy, Food Sovereignty, and Parallel Systems. TFTC's major episodes this week included Marty Bent's conversation with Will Harris on the industrial food system, along with continued discussions around Bitcoin, energy infrastructure, and freedom technology. It wasn't strictly a Bitcoin price conversation, and that's exactly why I found it interesting. Bitcoiners increasingly seem to be broadening the concept of sovereignty beyond money. Food, energy, privacy, communications, AI, health, local production, these things are all related. Once you start questioning the architecture of money, it becomes difficult not to start questioning the architecture of other systems too. That happens to connect nicely with this week's featured essay, which is entitled The Discipline of Enough. This essay is part of the broader sovereign life work I've been developing. Bitcoin teaches us to think about scarcity, but one of the stranger lessons of accumulating wealth is eventually learning that more is not always the objective. There's always another Bitcoin you could stack, another dollar you could earn, another investment you could optimize, another promotion, another house, another car, another number. But at some point, accumulation without purpose becomes another treadmill. The discipline of enough is learning to understand what the money is actually for. Freedom, time, family, health, experiences, the ability to say no. The ability to work because something interests you rather than because you desperately need another paycheck. And ironically, one of the things Bitcoin taught me is that low time preference is not simply about saving forever. It's about using resources intentionally. Saving matters, but so does living. You can read the full essay in the link in the show notes. And as always, if you enjoy the show, please check out my Bitcoin Fortress books. We now have 4 books in the Bitcoin Fortress library. Bitcoin Fortress, A Simple Guide to Bitcoin for Beginners. Bitcoin Retirement and Estate Planning. And I've looked around and I haven't seen too many books out there that are actually focused only on that topic. So check it out. Also, The Bitcoin Lifestyle and the newest book, The Architecture of Money, which takes a step back from Bitcoin itself and looks at the monetary architecture surrounding us. Debt, central banking, inflation, fiscal policy, monetary history, and ultimately why Bitcoin represents such a radically different foundation. If you've followed the macro series on the Bitcoin Fortress Substack, much of the intellectual journey will be familiar. And I'm already beginning to think about where the next book goes. The next project is increasingly looking less like another book strictly about Bitcoin and more like a book about sovereignty itself, money, work, time, health, attention, and building a life with enough independence that you can choose how you want to spend your remaining years. In other words, the sovereign life. More on that as it develops. Well, folks, that's going to do it for episode 229 of the Bitcoin Fortress podcast. And I think the lesson from this week is pretty straightforward. Don't confuse the Bitcoin price with Bitcoin. Prices fluctuate, narratives change, capital rotates, speculators arrive and disappear. But underneath that noise, infrastructure keeps getting built. Bitcoin is being integrated into banks, ETFs, corporate balance sheets, credit markets, energy markets, custody systems, global monetary infrastructure. Of course, none of that guarantees Bitcoin goes up tomorrow, and frankly, it doesn't need to. Bear markets are where weak assumptions get tested, bad leverage gets flushed, poor business models get exposed, and strong systems quietly improve. So maybe this summer of boredom is exactly what Bitcoin needs. The tourists are gone, fees are 1 sat per VByte, blocks keep coming, and those of us who've been around for a while know what to do. Zoom out, keep learning, stay humble, stack your sats, take care of your keys, spend time with the people you care about, and keep building your fortress. Thanks again for listening. And until next week, stay sovereign, stay positive, and I'll talk to y'all at the next block. Bye-bye.